Welcome, 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 everybody. This is Trevor Beal. I'm with the Beal organization. Hey, what I do is protect families, create access to cash for that's tax free, and also start retirements for small business owners, entrepreneurs, and that sole proprietor. So I'm excited. I'm so excited about today because I've been trying to put together this interview for a while now because I know people out there want to know how to do different things, how to do different things legally when they're doing small businesses. So we have a special guest with us today, and I'm excited about it. We have the Legacy Partner Innovations with us today. We have Teresa Otañez and Mario Peralta. So they're going to talk to us about what we should be doing as entrepreneurs, what we should be doing as small business owners, what we should be doing as sole proprietors, how we should be structuring things, and they're just going to give us the blueprint and give us the tell us how to do everything. How are you guys doing?
We're
Hi.
well, thank you. It's an amazing Sunday. Blessed and fortunate to be able to share some snippets and some valuable information to everybody that's listening on this Sunday.
Okay. So before we get started, can we do a quick introduction? How long you guys been in the tax business, and how long you guys been fixing people's mistakes for years? Let's start with you, Teresa.
I've been in the tax industry for a long time, formally and informally. I actually started preparing taxes at the young age of 12. My dad had a tax business, and I was back in the ages when you had the carbon copies. You'd have a copy on top and then at the bottom, because we didn't have copiers. You have a carbon copy in the middle. And back then, you didn't have your TurboTax. You didn't have any software that could help you with the taxes. You actually had to read the publication from front to back. So my father started doing that. He was in his 30s, and I was his secretary or his assistant at the young age of 12. Been doing it off for a long time, but mainly focusing on individual taxes. And with the help of Mario and his background, now we teamed up, and he can let you know a little bit about himself, but more of the corporate side now.
Awesome, awesome. What about you, Mario?
So when it comes to taxes, I've been active for the past 13 years. And my tax preparer actually asked me to join him and start working under his company. So that's how I got started. And so along the line, I saw a lot of different changes when it comes to tax years. And the beauty of it is that a lot of the times we get clients that are trying to fix problems that happened in 2012, 2013, and you can still remember those rules. There's a lot of forms and publications that changed during the years, but you can still go back and you can master knowing those rules. A lot of new preparers that starting this year, they might have a little bit of trouble because they have never encountered those kind of issues from the past. So it's an amazing journey when it comes to doing taxes.
Wow, that's excellent. You guys got a wealth of knowledge, and that's why I'm so excited to be able to talk to you guys today. So let's jump right in. What would you say is the most overlooked tax deduction that small business owner? If I'm an entrepreneur, I'm a small business owner. What's the most overlooked deductions am I missing? What would you do? First thing that comes to your mind? What's going on here?
There are several of them, but just to give an idea of the scale and the amount of missed deductions that are on average missed by small business owners, it's tremendous. So on average, a business owner in the US overpays about $11,000 annually.
Wow.
That's according to various studies and reports. The exact amount can vary depending on the size of the business, the industry, and the complexity of their finances, but it is an overwhelming and astonishing figure. Of those 11,000, this is what's mostly overlooked for the tax deductions. The first one is home office expenses. Even if it's partially used for a business, you can write off your home office. Another one that not a lot of business owners know about, but it is available, especially if you're new, and if you're just establishing your business, is the startup cost. You can deduct up to $5,000 in your first year. And this is a deduction for expenses prior to you even opening up your doors or, starting your business. So that's an important one to keep in mind. You can also write off the mileage and vehicle-related costs for the part of the business use of your vehicle. Other unknown deductions and items that are overlooked are such as educational expenses for your skill development. So if you have to take courses, classes, or you have to renew your education every year to stay in business or relevant, those are also tax deductible. You also have your utility bills, such as your internet, your phone, and other utilities to operate either your home office, a portion of them, or your separate office if you have another one. And one that's also overlooked a lot is that you're able to write off bad debts related to your customers who default on their payments. So
Oh,
those are the ones that, catch my eye right now. Mario, would you like to add some to that?
One of the things, and thank you for that. One of the things is that a lot of people overlook also is going to be the depreciation. A lot of the times, some tax preparers do not want to engage in depreciation rules simply because it can be a little bit tricky. But depreciation can be a huge deduction for a lot of people, especially like if it's a new startup. You're going to be deducting the computers that you just purchased, the chair that you're using, the desk. There's so many different things that you could actually depreciate, and that's going to work towards your benefit when it comes to lowering your tax bracket.
wow, wow. So, I mean, you guys just rattled off all these things, and it's amazing because I know a new business, they don't know this. And when you say home office, is there a certain amount of square footage or any room, or how do you kind of gauge that?
So it's a certain percentage of your home, and there's two
Oh,
different
okay, of the home,
deductions.
not the
Okay.
room.
Right, correct. Well, it is the room. So, for example, you dedicate one room that you converted to an office, or you have an office, it will ask you for the square footage of that area that you designed solely for your business compared to your entire home. So let's say your home is 1,000 square feet and you use 100. So 10% of your home expenses will go towards a deduction, everything that you pay, a mortgage payments, all the expenses for the home, and we can divide them up into the whole home. And then there's only office only. So if you have just you have a line for internet just for your office that you're paying for maintaining, or if you have water service or cable or whatever you have just for your office, you can deduct those as well. And as Mario pointed out, depreciation. So if your home is depreciated, the percentage of your home is also a tax write-off because they're using that depreciation, as well as your real estate taxes for the home portion or percentage that you're using. There's two
Amazing.
different. There's one where it's a percentage, and there's one where it's a simplified one. And that one has, I think it's $1,500 at most that you can write off for your home office. But it depends on which structure which one you want to use, the simplified home deduction or the one that requires you to itemize every expense.
That's
Mario?
amazing. We don't know these type of things, and I'm so glad that you were about. Let's go into my next question. My next question is me. Let's say I got a new startup. How should I structure my business? How should I structure it where it's the most tax efficient way?
Well, it all depends on your needs and what you're willing to invest in the beginning and your long-term plans. For example, the fastest way to start a business, but also you have more liability. It's a lower startup cost because you don't really need to do anything other than register your business and get your licenses, is a sole proprietor. However, with tax advantages, you don't have as many tax advantages as you would with an S corp or any other partnership. So proprietors are also depends on the business structure. Will determine your responsibility or your liability. As a sole proprietor, you are fully responsible for all debts and everything, and it's not a separate entity as yourself. That's why it's called so. You're responsible for anything, any lawsuit, any debt, anything that goes well or wrong. You are responsible for that business wholly 100%. Different from an LLC and an S corp, it's a separate entity. And those, as you move up, LLCs have a higher cost of setting up, and then S corp's a little bit even more expensive, but they all have their pros and cons, and it all depends on your needs. But a great example would be, you have to evaluate each one and if you come to the conclusion, an S corp can allow you, you pay yourself a salary, it helps you reduce your self-employment taxes. If you have a regular job, you pay half of your taxes, and your employer pays the other half. Well, as a sole proprietor or an LLC, you are both the employer and the employee, so you pay full taxes, which is about 15%. With an S corp, you're able to reduce some of those self-employment taxes. So that would be one example.
Oh, that's excellent. That's good information. So it's kind of before you even go into that part of it, it's figuring out what I really want to do. Like, right, how do I really want to do this? Like, because if I'm a bake shop that's just baking cookies out of my kitchen, right? I might start with sole proprietor until I get bigger. Would you say that there's a like a profit or money that's coming in threshold to start to go from like sole proprietor to LLC to S corp? Would you say that, or no? Not really. You should just start whatever startup you're coming in.
You're right in the sense that it all depends. If you're just going to just freelance, you're not going to see clients. It's very easy to keep track of your expenses. You're going to mostly be working from home. Then a sole proprietor may work for you. However, and there's no threshold. It all depends on your goals and your liability. But let's say that you are going to interact, you're going to have accounts receivable, accounts payable, you have different clients, they're going to see you, they're going to visit you, you have a vehicle, you have things that increase your liability, then is when it's recommended to have more of the LLC and then the S corp setup, or otherwise you will, if something were to happen, as here in California, everybody gets it's stir crazy when it comes to lawsuits. This is a way of protecting yourself, is by setting up your company or your business with the proper designation, as well as the tax savings.
No, that's
And not going so much into detail when it comes to the structure of DBA or sole prop or LLC or S corp or C corp. Regardless of what you have, you always want to you want to be able to attach an EIN number to any of those, so that way you can have a business account, and that will separate personal expenses from business. So if you're like more into, I want to be audit free, I want to make sure that all my expenses are qualified as business expenses, that'll be the number one way. You want to open also your business account.
So getting an EIN number for the people out there, getting an EIN number is basically like the business social security number.
Correct.
Yeah.
And is that how easy or how hard is that to do?
It's very easy. And we have somebody on our team that can help you with that, but it stands for Employee Identification Number. And especially now in this age and time, you don't want your social security number, out there, right? You could use your social security number to pay, let's say, a contractor or give somebody a 1099 NEC. However, you're better off getting an employee identification number with an IRS. They have a link in a website. That number allows you to set up a bank account. Otherwise, if you go into the bank and you say you have a business, they will not let you set up a business bank account. And this way you can keep, like Mario mentioned, all your expenses and your income are receivables separate than from your personal banking.
That's excellent. Yeah, no, that's good. This is good stuff. Going to my next question. What are some key deadlines that every business owner, every entrepreneur needs to know about? Like, if you're just doing your regular income taxes, the number that's circled, the date that's circled on everybody's calendar is April 15th, right? But if you're a business, what are some deadlines and dates that they need to know?
So I'm glad you brought that up, because April 15th is the actual deadline for personal income taxes. And if you're a sole proprietor or have an LLC, those deadlines are always on April 15th. However, if you have an S corp or different type of setup, your deadline to file taxes are in March 15th. In addition to that, if you do have to pay estimated taxes as a business owner, when you're an employee, they deduct on your weekly paycheck. Well, you don't have a weekly paycheck. So the way that the government receives that, captures that revenue or income for them is they have quarterly estimated taxes. So when you filed your taxes, you'll have a quarterly estimated taxes form, and those deadlines fall on April 15th, June 15th, September 15th, and January 15th for you to be able to pay those taxes as you go for your business taxes.
Oh no, yeah, that's
Also important.
go ahead.
It's also, I mean, I was going to get into more details, but it's probably overwhelming at this point. But with your sole proprietor and LLCs, you have your tax year beginning January 1st to December 31st. But if you have an S corp or any other setup, then your fiscal year could be on a different, not a calendar year. It could be a different year.
Got it. No, that's so would you can pay, so you're saying you're paying quarterly, like if you're an LLC, you can pay quarterly. You said it's 1 month before the April 15th, March 15th, correct? That's the first one, or that's the deadline?
So to clarify, LLCs is considered a sole proprietor, almost not a separate entity for tax purposes. Legally, it is a separate entity, but for tax purposes, they consider it as a sole proprietor, especially if it's a one-member LLC. That's due on the same day, April 15th, as your personal taxes.
Got it.
A month before, it's mostly for corporations or other companies.
Okay, so corporation, that's cool. Okay, got it. Okay, got you. Yeah. No, this is all good stuff, and I think I'm so glad we're doing it because, I help people, small business owners with their wealth creation as far as like keeping wealth and that legacy, keep making sure that their families are protected. But everybody nowadays seems to have a business, right? So, doing it the right way, and understanding what they can do and what they can't do, is really crucial. So just going on top of that, what strategies can I use to I guess minimize the self-employment taxes legally?
Yeah. So one of the key ones is, as we mentioned, you use the S corp structure to limit self-employment taxes. This way, you're paying yourself a reasonable salary, and you don't pay. You're not double taxed per se. You're also able to deduct, because as a business owner, you have to buy your own health insurance. So you're able to deduct your health insurance premium. You're also able to maximize your retirement contributions. Instead of your traditional IRAs, you have your self-employed IRA, your solo 401ks, or your simple IRA. So that's a good way of minimizing the self-employment taxes. The more you put into your retirement, the lower your tax bracket may be, depending on how much you contribute, based on the IRS limit, but that does help you reduce your self-employment taxes.
Got it. And Mario, maybe you can answer this. What Teresa said, reasonable salary, paying yourself a reasonable salary. What would you say is reasonable? Does that have to do with how much you've taken in, or what? Or reasonable could be anything from different persons to different persons, right?
Yeah, that's pretty much when it comes to like, setting up different goals of what is it that you want to do in the long term, right? One of them, for example, is you want to also put yourself on a W-2 in a lower bracket, especially if you're going to be doing any distributions from the company or reimbursements.
Okay.
So a lot of the times, if you're going to start your business for the first time, you're going to put money out of your pocket to start the business.
Right.
That's a loan that you're giving the company to get it started. Along the line, once the company starts making money, you want to reimburse yourself from it. So of course, you want to also lower your tax bracket by not putting yourself too much on payroll, or and also have those distributions or reimbursements coming back to your pocket. So that's how you want to factor out how much you want to get yourself paid, considering that you will get also reimbursements from the company.
So if I heard you correctly, if you're a startup business, you basically put up all this money up front. The business can pay you back that loan
Exactly.
after. And is there like, let's say you don't start making money till year 3, can the business in year 3, they can start paying you back from year 1 and 2?
Yeah, of course. It's an open note. It's like a note. You keep an open note. You have to always respect the company and keeping everything separate from your individual. You always have to make sure that you note every single dime that you put in into the business as a loan. And let's remember that most people are working on a W-2 trying to open up their own business. So they already paid the tax on this money that they're putting into the company. So of course, when it comes to distribution of reimbursements, it's going to be tax-free simply because you're getting back your investment.
Right, right. Now that's a key point, that you've already paid taxes on this money.
Yeah.
I don't think a lot of people realize that you already paid taxes on this money.
And it's no,
Go ahead.
Trevor, that it's no different than, let's say, hey, you know, I have 50 grand extra. It's no different than, hey, I'm going to go buy myself a car, or I'm going to go on a shopping spree, versus, hey, I'm going to put it in a business because I know that it's going to grow. So it's the same thing. Like Mario mentioned, you've already paid taxes and we're able to spend it the way that we want. But this way we're investing in something that we know is going to generate wealth, you know, for us and for future generations. So it's a way of reinvesting in ourselves as well as in the future.
Yeah. No, I love it. I love it. Teresa, you were talking about estimated taxes earlier, just a minute ago. How does that work really? Like, how do you handle that? And then what happens if you miss one of those payments?
So there's a form that the IRS uses, Form 1040 ES, and your tax preparer CPA are able to fill it out for you. And they will let you know approximately, hey, how much you are, you know, are going to, they're going to estimate how much they need to collect from you to pay for your taxes, your self-employment taxes and other taxes, right? Social Security and all that that comes together. So they, based on the data and information that you put, they estimate how much you're going to pay next year, and then you have to make those payments. And if you miss a payment, you have to make sure that you file a Form 2210 to apply for a request for a waiver. The government doesn't always, you know, grant it, but that's available for you to request it, especially if you're going through a financial hardship. But in order to prevent the penalties and the fines from going up, the sooner that you pay them in a timely manner, it's the best way to go.
Got it. Got it. Yeah. Yeah. No, that's good. I mean, and so as far as handling it is basically, you got to schedule it out. Hey, there's a payment, as you know, I got to pay my estimated taxes, you know, just like you paying for that car note, right?
Correct.
Got
Or
it.
similar to your property taxes, you know, hey, you know, you have to pay them twice a year if they're not impounded in your mortgage. It's similar.
Yeah. No, that's good. That's good. Um, so now I get to that
And this is
time.
Yeah, and I would say this is done at the time of your tax preparation. That's when you
Okay.
get the estimated amounts, when you prepare your tax.
Oh, okay, okay, got you. Got you. So now I wanted to go into that 5-letter word that we all like, we're all so scared of, the audit, right? So what are steps we could take, you know, just to prepare for maybe like there's a potential audit, or yeah, you know what I mean? Like let's say that you get that letter in the mail saying there's audit. How do you prepare to, you know, take steps to for that? Like, is it, am I just calling you? Just do I just call you guys and Teresa, Mario? Look, I'm scared to death.
Well, I know there's definitely various ways of going about it, and depending on what designation you give your tax preparer, some of them are able to help you with that information, you know, if you give them permission and you speak to them. But the best way to prepare is to take care of and keep thorough, organized records of all your incomes and your expenses and receipts, and keep them. So when you prepare your taxes, make sure that you keep all those files that you use to when preparing the taxes, that you keep them separately, and you keep them up to sometimes 7 years just to make sure that there's going to be an audit. And of course, you call and, we can provide you all the information, but that's the best way is by keeping those records. Make sure that every month, you prepare for it. You don't just, there's always a risk and there's always a possibility. So the best thing is to be prepared so that you're not caught off guard and then you're not in a panic mode and freaking out, and then that you have the document. So it's best to make sure that you take a look at the information and reconcile your accounts monthly. You consult your tax professional for audit readiness and to make sure that you're complying with everything that the IRS is requesting, and as well as that you answer their notices. Don't think that, oh, okay, I got a request for an audit, I'm going to ignore it. No, that's not gonna work. You have to make sure that you respond, because then there are repercussions if you're not responding to their request for either additional information or questions.
And is that something that you guys help with too as a agency? Like would that would okay, this is we're preparing you to to stay out of an audit first of all, and we're preparing you to to help if something does happen.
I know Mario has done a great job at assisting some to answer those questions. But the way that we prepare you is we give you all first of all, the best way to prepare is to properly file your taxes. So if you follow all the guidelines and the rules, then that's the best way to protect yourself from any future audit. So that's where it begins. Saving your records, making sure you present them when you file your taxes, file them correctly based on accurate information. And then the second one is by having all those records and documentations available when there is any question that arises.
Mm-hmm. Especially what she mentioned when I was like the keywords is like just being proactively reporting everything correctly. A lot of the time, just like people that do investments, some of our clients come in with like a list of $100,000 of investments or losses, and they want us to report everything. For the most part, we know that there's going to be a threshold, and there's going to be a limitation where the IRS is going to try to question you. So the best way now, to fight an audit is not to have one to begin with.
Right.
So we want to be able to be conservative. Don't go aggressive on your tax file. Make sure that everything we report is according to what they're asking for, and especially following every single line that we're filling in. If I have a dental hygienist, there's no way I can put tools on them. If I have a construction guy, I'm not going to put suits on him, right? So it has to do with the expenses. The expenses have to qualify or match the environment. I'm sorry, the work industry that they're in. So the best way to handle a possible audit is just not getting into one.
Right.
And that's when your tax advisory comes into play to allow your client to let them know, I like your numbers, but you're pushing your numbers.
And let me ask you, I know growing up, my dad owned a construction company, and I mean, there were just stacks and stacks of receipts and receipts. With all the technology that we have, do you still have people coming in with with stacks of just receipts, or is it basically all on the computer now?
And everybody comes with the receipts still. And the previous audits where I have to sit down with my client, and thank God there are not many. The auditor will probably much come around into our office and they will randomly pick out a receipt. And they want to match it to your bank account. They're not going to go through every single receipt. They're going to just randomly pick 3, see if they actually belong in your account. And that's one way of doing it. And they're going to say, okay, we're done. They're not going to go through every single receipt. They just want to make sure that at least you match some of them. Or if the expense is valid, they can question, hey, why did you put this vehicle into depreciation or whatever? Now you have to justify why. One of the biggest audits that we had, very common, we had to fix when the client came from other tax places, is that they had recorded gas payments or diesel payments on their trucks, and they also had put mileage. So you can only do one or the other. And that was the most common things that we will see that we had to fix.
That's a red flag. Red flag.
Right.
So yeah,
Go ahead, I'm
So,
sorry.
so would you say, so
Like,
would you say like if I pay with everything with a credit card, is that credit card statement, is that a receipt?
A lot of the times, if they were to see a credit card payment, take in mind, I haven't gone to any kind of audits, and knock on wood. Um, they want to say, okay, you went to CVS and you purchased, 40 or $50. How do we know which part was medicine and the other one is because you bought a candy from there?
Mhm.
So they don't know if the total bill actually adds up to the purchases that you made. Luckily, there's a lot of companies nowadays that they send you a digital receipt with the items that you purchased.
Mhm. Got
Like
it.
Home Depot is great when it comes to that. They'll send you a receipt and they'll show you everything that you purchased.
Right.
Now they can classify this is a tool, this is a tool, this is material.
Yeah.
So that's a great segue into what Mario said. Like, for example, in the past, you could buy food from, let's say, a market or somewhere. You were able to buy pre-made food from markets or different places and take to your employees or to your clients. Not long ago, the IRS changed that and it says it has to be purchased from a restaurant, even for entertainment. So it's part of the meals and entertainment, right? As a write-off, when you entertain clients or you providing meals for your employees, you're able to write off a certain percentage. Well, in the past, you could, go to a supermarket or you could go anywhere and they would have, ready meals or ready available for you and you could purchase them from there. That changed. And so now it's like it has to be a receipt from an actual restaurant for those meals. So, probably because like Mario said, maybe people were buying groceries at the same time, or I don't know why, and and then they bought food and who knows, and then it had the itemized, but they've changed the rules because of that. So now entertainment is limited to food provided by restaurants, whether it's a takeout or dine-in, but you can't purchase meals from any other place.
Wow. Well, Teresa, you're taking me right to my next question. Changes in tax law. If I what's out there now that's like, oh, okay, well, this is about to change, that we need to know about. Well, so it's something, give me something big and do something big.
There are a lot of changes coming, but we don't, I mean, Mario probably is better at answering this question. I know there's some that's changed recently, and with the new presidency, I know there are more to come with, when it comes to business expenses. Like before you were able to write off more business expenses, and now because you have a higher deduction, they don't allow you as much, right? A personal deduction. But I can't think of any on the top of my head right now that is a key. Mario, could you think of any that just changing within this year?
This year, not a lot of changes. Most of the changes took place in 2018 when it came to the last tax reform that we had with Donald Trump. We were under the assumption that the changes were going to take place again in 2025. So we haven't seen a new reform for them to say that there's going to be a drastic change when it comes to self-employment. For the past 5 years, we had the same kind of deductions and very little changes, and especially the one that you just mentioned right now when it came to the meals. And just going back to the meals really quick, most of the time, whenever I have a client that says, "Hey, I purchased meals," or I took my client to a restaurant or whatever, you always want to follow up with an email. You always want to follow up with some kind of communication. Say, "Hey, thank you for dinner last night. Hopefully, you can you can take my proposal into consideration." Something that will tie the meeting into the actual expense. Because to the IRS, is maybe you just took your date for a date. That's it. So you want to make sure that everything ties to business expenses. But yeah, very little when it comes to self-employment. Most of the changes that are taking place are more like towards the credits, when people are buying electrical vehicles or stuff like that this year, or when it comes to people with W-2s, or of course the credits when it comes to earned income credit and child tax credit.
Is the child tax credit is that something that usually changes every I guess every president?
Every single year it goes up an amount because of
Oh, it
inflation.
does. Okay.
So when it comes to earned income credit, they'll play with the bracket. It depends how much. Everything is tied on how much you actually gross. This including self-employed.
Got it. Okay.
And a lot of the times, and like, hopefully I'm not jumping from one thing to another. People ask me, well, if I make $15,000 on self-employed, why is it that I'm getting way less if I make 15,000 on a W-2? And that's simply because there was tax withholdings on a W-2.
Mhm.
So self-employment, when you do your taxes and they're going to give you those credits, they hold back self-employment tax.
Got it. Excellent, excellent. Oh, I love it. I love it. So Teresa, you talked earlier about, putting money in a solo K as an entrepreneur, talking, putting stuff away for retirement, right? We talked about retirement. Is there like a strategy or a planning process that you had, like planning as far as like putting money away for retirement as a business owner, compared to me planning to reinvest that money back into the business? Like, is there, you've seen so many different businesses probably, and is there a strategy, or is there a planning advice that you can give us to tell us like how to do that properly, or which
So,
one kind of to weigh both of them?
yeah, so it all depends on your needs. So in the beginning stages of your business, you probably have to invest or reinvest most of it in your business because you have upfront startup costs and to also be able to grow. But once your business is steady, the best way to invest in your future, as well as and the one with the tax saving for self-employment, that's why I recommend an S corp, is that you take those deductions, so you pay less taxes. The less taxes, and the more that you will have for the long term and the short term and the long term investments and retirement for you and your company. So, like I said, the best way is this S corp for self-employment taxes to minimize them. You're also able to deduct your health insurance premiums because as a business owner, you have to pay for them independently. And a lot of people, this is a secret also, business owners, they have a spouse and the spouse sometimes doesn't work. Well, you're also able to open an account for a non-working spouse based on IRS rules. So as a business owner, you could set up your own self-employed IRA or solo or one for your spouse as well. And when you do that, that reduces your tax because now that's, tax deductible. There are other ways, depending on your needs for the retirement, because depending on how you invested your money, whether it's a traditional IRA or pension versus a Roth IRA, some you will pay taxes now. And when you take out the earnings or itself and you take out it's distributed to you, you would have to pay taxes then. If you don't pay the taxes, it's inversely. If you pay taxes now, when you withdraw it, it's tax free. If you don't pay the taxes now, like we're using it to save on taxes as a strategy, then when it's withdrawn, you would then you would have to pay the taxes. So it all depends on your need and how you see your income's going to grow. But definitely you have to make sure that you diversify and have different structures depending on your need. I also recommend, insurance policies like IULs. I also recommend annuities, which is almost, preparing, you pay into it as an insurance. And when you retire, you will get a monthly income as well as, whatever you get from your business. So it all depends on your needs and where you're at and what stage in life. And it depends, like I mentioned, on short-term and long-term goals.
Real quick, I want to touch on what you said about your spouse. Doing an IRA for your spouse? Can I do one for myself and my spouse?
Correct. Even if they're not working.
Okay, and then is there a maximum number I can put into both of them?
Yes, there is. And they change every year depending on your age. After 50, they have like a catch up where they let you add additional money to it to catch up for your retirement. Prior to 50, they all have a limit.
Okay, okay. And then one more question. Let's say I have my daughter, I have a daughter that's 8 years old. If I have her working, let's say just passing out flyers or doing something, I'm putting her to work, right? can what's the maximum amount I can pay her before before taxes come in, or is it a write off? How does that work when you have your children involved?
Mario, do you want to chime in a little on that one? I know that
The answer can be,
treasurer, but
yeah, the answer is going to be 10,000. You want to keep it out within 10,000 so that she doesn't hit a higher tax bracket. So $10,000, she's going to be still be like at the 10,000 at the 10%, and she's not going to pay much. She's not going to pay taxes at all. I should say, yeah. So you want to keep it at the 10,000. That's going to be self-employed. Of course, we don't want to get into a conversation when it comes to the kiddie tax because that's going to be a separate conversation. But that would have been your answer, 10,000.
10,000. All right, that's what I'm looking for. 10,000. I got to put these kids to work.
because remember, if they make too much money, you can't like you mentioned kiddie taxes, and you can't use them as dependent for your write-offs.
Oh, that's a good point.
Something you have to consider. And then second, kiddie taxes, you can go in details. If they make more than a certain amount in dividends or interest, then guess what? It gets tax strategy that you have to know about. Because in the past, what parents did is they paid their children and they get all this interest and all that so that they didn't have to pay taxes on it because they were in a higher tax bracket. And when you're young or small or just starting or, in your early teens or 20s and you're just starting and your entry level positions don't pay as much, that's not, and if they're using them as dependent, that doesn't work anymore. They closed that loophole.
Okay, that was one of the tax changes, right? But no, 10,000, that's what I'm looking for. 10,000. Okay. So there you go. Me being IUL, I love IUL. So 10,000 can go right to her IUL. That's good. Yeah. So independent, if I'm an independent contractor, there's independent contractors and then there's hiring regular employees, right? What should I know about both of them? Like versus like, can you break down like hiring somebody as an employee or hiring just an independent contractor as far as tax purposes? What is there a better option, or what should I know about either one?
Well, go ahead, Mario. I would say just so that misclassifying them to save money. The IRS has very strict policies and penalties now, and they have some guidelines. So go ahead.
No, I'm sorry. So exactly what you just mentioned, when it came to like not classifying them correctly. So you have to rely a lot when it comes to labor law. What defines a direct employee to a freelance employee? And when it comes to an employee, if you're pretty much giving them the schedules, you're giving them the tasks and so forth, those are your employees. If you give somebody, for example, a plumber that comes into my house and says, hey, I could do whatever work for this amount, those are just freelance. So I'm not pretty much putting them on a schedule. I'm not telling them how much he's going to get paid for it. He's giving me how much he's going to charge me for it. And this was a huge thing when I believe it was Proposition 22 when it came to Uber, when they were classified as freelance and considered to being employees from Uber. And that happened, yes. I believe, 2 or 3 years ago. And so that was a big thing.
Yeah, the main key is, like Mario mentioned, is schedule. Do you control and dictate their schedule, and do they have to go to your office or do they work somewhere else? And also, because of that, do they also work for anybody else? Because if you're an independent contractor and you're the only one that's reporting income to them, there's something wrong with the picture, right? And if they're coming to the office and you give their schedule, then the scheduling, as well as do they have other multiple income sources besides you?
So schedule is a big thing. Okay, who's controlling it?
And for the most part,
and as well as,
I'm so sorry. There's like a little delay that he said. I hear talking like 2 minutes after. I'm sorry.
No, you're good. You're good. Go ahead.
One of the biggest infractions that we see is when it comes to employees or employers, that they have their employees half of the time as W-2s, and for the 40 hours, they want to avoid the overtime. And so they put them as freelance on the remaining hours. And that's a huge infraction because now you're violating workers' comp codes and especially unemployment. EDD is going to come back to you saying how do we know when this person got, if they were to get injured, how do we know if, like when they were classified as a freelance or they were actually your employees?
Mhm. And Teresa, what were you going to say?
No,
You
that's
talk-
the same, like you said, it's schedule as well as who else they work for, and you can't combine both. You can't, they can't be independent at the same time unless they're doing something else for you. Let's say they work for you from 9 to 5 and they're your accountant, but then they also bake, they have a baking business and they're catering something to your company. Well, that's different, right? You can have both. But if they're doing the same and performing the same business duty, then yeah, that's a big red flag.
Right. No, yeah, that makes a lot of sense. A lot of sense. All right, so just kind of just wrapping this up into a bow. Um, what would you guys say the best practices are as far as keeping good financials, keeping accurate financial records, and just avoiding like costly mistakes? Like what would how do you guys recommend like doing that, like for a new business owner to just coming in and say, should I be looking for? Like am I got the old folder that I'm writing down. I went to the gas station. What do you guys
The log
recommend?
sheet, right? You're keeping a log.
Log
You're
sheet,
talking
there
about
you
the
go.
log sheet, and as well as back then it wasn't even a log sheet in accounting, the ledger. You'd have a ledger
Ledgers.
and accounting ledger, yeah, or log sheet. I say it's interesting you say that because sadly enough, like right now with the fires, you realize that a lot of the documents that you have that are hard copies, and even in your computers, if you don't save them to the cloud, they're gone.
Yeah.
So the best way is to use an basic accounting software, because you can, so if there's ever any question, you're able to go back and look for them. So using iCloud accounting software is important. You have to always make sure that you're separating your business and your personal finances. That's why getting an EIN number will help you open a business account so you can keep all your transactions separately. As well as that you check, oh, I used the wrong card. I may have two American Express cards and I use my personal for my business and vice versa. So it's very important to do that and retain your records for as long as possible. I know IRS requires 3 or 4 years sometimes for certain audits, but for corporations or bigger entities, and they may require they can go back as up to 7 years. So the longer you keep the records, the better. And of course, the papers, don't want to have old papers. You can either scan them or use a cloud-based something that makes it easy for you to input the information to retrieve it when you need it.
Got it.
And there's
I
some
agree with you.
software like Intuit offers a lot of products. Different, yeah. They offer you all that, you have different accounts and gives you a picture, and you can, when you reconcile your finances every month, there's always a little item description where you can describe what kind of expense it was or what kind of income it was, so that you can keep track.
Yeah. Yeah. Mario, you was going to chime in?
No, and that's the thing. Like in our office, we like to keep control of most of the bigger companies, or even small companies, of course, where we control like all of their accounting. We want to make sure that we have a P&L at the end of the year and like have everything ready. So December 31st, you're pretty much completed. You don't have to do any more math. So
Right.
we provide that kind of service as well.
Yeah. Yeah. So before we end out, I got to know one thing though. What is the number one like mistake that you see new business owners do all the time? Like you guys just like pull your hair out, like, what? Don't do this. What would that be? Like I'm brand new and I'm like, I'm so excited. I'm about to start up a new LLC. I heard all this stuff on TikTok and Instagram and all this stuff. And what is one mistake you say don't, you see it all the time? Is there one?
So one of the ones that I see most of the time is, if it's gonna be business, is not knowing. Well, let me go back. Just the business itself, not knowing your neighbors. I have a tax office. I want to make sure that there's no tax officers within the range of like the facility, right? But once I start setting up my office, a lot of the times we don't take in consideration the actual expenses that we can be accruing during that time. we think that we're gonna have $15,000-$20,000 in our pocket, and sometimes it's not gonna be enough for us to cover, like for us to actually do a complete setup. And we don't take in considerations all the expenses that are going through. Most of the time, at the end of the year, you're thinking, "Oh, I spent maybe like around 50,000 in my project." When you see the actual math, you paid 85 to 90,000. And you never like took that into consideration. So I just like think that a lot of times not proper planning is one of the reasons that a lot of new companies will fail.
Yeah.
It's
You
simply
un-
uh-huh.
The biggest is they underestimate expenses and overestimate sales or revenue. Because everybody's very optimistic when you start. And you have to take into consideration that to establish a business, a long-term one, it's going to take some time, you know, investing, initial startup, reinvesting. But I think one of the key factors that can help you so you can get a better picture is keeping accurate records. Because you may think you're making all this money, but you don't realize that you're using a credit card and the credit card's not attached to your business. And then like, oh, I'm making all this money. And then you get all the statements months later, like, oh, you know, I had all these expenses. So like Mario mentioned, it's underestimating expenses and overestimating income revenue and not keeping proper records of them to give you a clearer picture and to see if it's worth it. Because not all business is good business. So if you're losing a lot of money, even though it's your passion, you have to come to a point where like, okay, well, maybe this is not a, you know, either the structure's not great or maybe your marketing, you need some improvement, but you have to do an assessment. And that's why it's important to me with your tax preparer, not just at the end of the tax year, but during the year. Hey, look, this is where I'm at right now. Am I doing everything properly? Are there any savings or money where I could put somewhere else, or any credits that are coming that I could take advantage? Because let's say, you know, like for example, the electrical vehicles, if you're getting a credit, that money's going to come back to you if you owe taxes. And if, you know, and you need a vehicle, then you might consider purchasing that if you know that that credit is available, but then it expires or it doesn't, and then you're buying a car. So it's always good to double check to make sure that what credits are available, which ones are going to expire, so that if you are in need of such product or equipment for your business, that you take advantage of those credits.
Nice.
And especially not to mention business loans. So business loans are going to be huge if you want to get started and you haven't, you know, so you could actually have a budget for it.
Got it. Got it. So real quick question on top. How often should people or business owners be talking to you guys? Like throughout the year, like what would you say? Should I be talking to you quarterly? Should I talk to you monthly? It shouldn't be once a year. From everything that I've taken, I should be talking to you more than once a year.
Believe it or not, I do have clients that will call me at least once a week. And that's simply if they're purchasing something, is it going to be, they're going to be able to depreciate it. If they're buying a vehicle and it's below 6,000 pounds, or if it's over 6,000 pounds, are they going to be able to depreciate 85% of it? So little things like that. And then also not necessarily only sole proprietorship or people with businesses, but with W-2s. I'm about to withdraw a 401k. How much is it going to affect me? So one of the conversations that I had with one of my clients, she says, I have never, ever talked to a tax person that many times in 1 year. And that's simply, it gives them a peace of mind. It gives us a peace of mind that we can guide them correctly. So at the end of the year, there's no surprises.
Yeah.
Before it's too late. I like Mario had instances where, hey, you know, they forgot that they took, or they didn't know that they had to report when they took money out of a 401k because either they left the company or they were laid off. So they take it out, not knowing that there's a repercussion and a big hefty penalty, you know, a penalty plus the, you know, early withdrawal and all that. So by the time that tax time comes in April, it's already too late. One, the first instance, they never mentioned it, brought it up until the IRS said, hey, your refund's less, or you owe us money. And they didn't know why. And it's because they had withdrawn from their retirement. One. Second, you know, if they tell you ahead, that person forgot the other ones due, and they didn't realize how much it was going to cost them. And so it's important, I think, like Mario said, on an ongoing basis. I think best case scenario, maybe once a quarter, at least twice a year, a mid-year review, and say, hey, this is where we're at. This is where I'm heading. These are my goals. This is what these are what my finances look like right now, so that you can prepare for all that.
All right, all right. Everybody heard that. At minimum twice a year. At minimum twice a year.
Best case scenario, every quarter. And as needed, like Mario mentioned, when you're making those purchases to determine if it's a wise investment or if it can be depreciated or deducted from your taxes.
Excellent, excellent. So, guys, thank you so much for your time. Thank you so much for coming on here and shining some light on these things that's much needed. Can you tell everybody out here where they can find you, how they can get in touch with you? If you give us everything, websites, Instagrams, phone numbers, where everything that we can get, they can get in touch with you, and where, how often, so they can start that once a week calling you, Mario.
Right. I can share my number.
He's like,
It's
I'm
gonna
not
be
giving my number out. Yeah.
Oh,
Mario's like, I'm not gonna give my number out. I'm just kidding.
I'll gladly give my number because a lot of the times, even if they don't come through our services, which is fine, a lot of the times they need a simple guidance. And if it's somebody that just says, "Hey, I'm gonna start my own business," maybe I don't have, maybe I'm not gonna be able to hire your services. It's okay. We want to be able to help as many people as we can. My phone number is area code 323-690-0963, and that's the best way to reach me.
Okay. And
My number is 562-400-1731.
any websites? Can we follow you on Instagram? Anything?
We do. We're actually in the process of getting our website. We just got the new partnership name because we all are coming from different, and we're actually consolidating under one roof. And we'll probably invite you to the opening, right? The grand opening, Mario, in the next few weeks at our new Downey facility. So we're working on that, and we'll also probably have a toll-free number. But is there an email, Mario, that you want to share, or the link to the website where they can schedule an appointment?
Yeah, definitely. You can actually send us an email to info@saviotax@gmail.com.
And I'm gonna put all of this up. It's gonna all be up on I'm take care of all of it. But yeah, absolutely. Legacy Partners Innovation. Yep. So we're definitely, I'm gonna have all of that for them and everything. And as you guys things change, I'll definitely update it. We're gonna update it. We're gonna get us out there, get you guys out there. So me being in the insurance agency, insurance industry, there's a lot of insurance agents out here that have their own businesses and they need these questions answered. So I'm definitely sending all my people your way. Definitely, so I can't wait till the grand opening of the new facility. But yeah, so hey, thank you everybody for joining us, and we'll talk to everybody soon. Thank you again, Legacy Partners Innovations.
Thank you,
so
Trevor. I
much.
shared a chat with you also where you're able to schedule appointments currently. It may change, but as of right now, I just changed to that link in the chat.
Okay, perfect.
Thank you.